Hello everyone, welcome back to the channel. This is Grow with Tony, and I am your host, Tony. It is truly a pleasure to have you here with me today. You know, human beings are funny creatures. We love efficiency. We love shortcuts. If we find a coffee shop we like, we stop looking for other coffee shops. If we find a route to work that avoids traffic, we drive that same route every single day for 10 years. We crave the default option because it saves us brain power. It saves us from having to make decisions. And nowhere is this more prevalent than in the world of investing. If you go to a dinner party or browse Reddit or talk to your colleagues about the stock market, you will hear one piece of advice repeated like a mantra. It's almost religious. Just buy VOO, just buy the S&P 500. Set it and forget it. It has become the default setting for an entire generation of investors. And I want to be fair right off the bat, it is a good default. It's certainly better than keeping your money under a mattress or gambling on penny stocks. But today we are going to look at the S&P 500 through a different lens. We aren't going to talk about beating it. We are going to talk about the risks hidden inside it. We are going to explore why defaulting to VOO might leave you less diversified than you think. And we will look at 3 sophisticated tools from Fidelity that can help you build a more resilient, strategically diversified portfolio. Before we dive deep, just a quick reminder. I am sharing educational ideas and strategies here, but this is not personalized financial advice, so please always do your own research before making investment decisions. Now let's peel back the layers of this onion. Why do we need to look beyond VOO? The Vanguard S&P 500 ETF is the giant of the industry. It's low cost with a tiny expense ratio of just 0.03%. When you buy it, you own a slice of the 500 largest US companies. But here is the structural reality of cap-weighted indices like VOO that nobody talks about enough. Cap-weighted means the bigger the company, the more of your money goes into it. As we speak, the top 10 companies in the S&P 500 make up a massive percentage of the entire index, hovering around 35 to 40%. Crucially, that concentration is driven primarily by just 5 or 6 tech giants, names like Nvidia, Apple, Microsoft, Amazon, and Alphabet. Think about that for a second. You think you are diversified because you own 500 companies, but in reality, your portfolio's health is heavily dependent on the performance of a handful of mega-cap tech stocks. If the tech sector corrects, your diversified index fund feels the pain immediately. So the goal today isn't to find a magic ticket to better returns. It is to find tools that reduce this concentration risk. We do this by using enhanced strategies and factor investing. We are going to look at 3 specific tools that take the core idea of equity investing but change the risk profile. Let's introduce our first tool. This is for the investor who wants exposure to US large caps but is worried about that heavy tech concentration. This is the Fidelity Enhanced Large Cap Core ETF. The ticker is FELC. I want you to visualize a standard index fund as a bus. The bus has a fixed route. It stops at every stop regardless of traffic or road conditions. It is reliable, but it is rigid. FELC is like a sedan with a driver who is actively watching the road conditions. It is still driving on the same highway, investing in large-cap US stocks, but it has the ability to change lanes. This is an enhanced ETF. The managers of FELC use a systematic process to evaluate companies based on fundamentals like valuation and growth quality. But the real value proposition here is risk management. Because FELC is not strictly cap-weighted, it can systematically underweight those massive, potentially overvalued tech giants that dominate VOO. It aims to provide a smoother ride. If the top tech companies enter a bubble and then correct, FELC's structure is designed to reduce your exposure to that specific crash compared to a standard index fund. However, risk management comes at a price. FELC has an expense ratio of 0.18%. That is 6 times more expensive than VOO, and I need to be crystal clear. Paying higher fees does not guarantee higher returns. In fact, many enhanced strategies have underperformed simple indexing during the strong tech bull runs of recent years. You are paying that fee for the potential of better risk-adjusted returns during volatile periods, not for a guaranteed winning lottery ticket. It manages a healthy $5.8 to $6.5 billion in assets, so liquidity is good, but you must decide if the diversification is worth the cost. Now let's pivot, let us zoom out. There is a huge bias in the investing world called home country bias. If you live in the US, you tend to think the US market is the only market that matters. But historically, market leadership cycles. There have been decades where US stocks went sideways while international stocks rallied. To truly diversify, you need to step outside the US borders. This brings us to our second tool, the Fidelity International Multifactor ETF, ticker FDEV. Let's break down that word, multifactor. Academic research has identified specific characteristics or factors that can drive returns differently than the broad market. The first factor is value, finding companies that are cheap relative to their earnings. The second is quality, companies with strong balance sheets and stable earnings. The third is momentum, stocks that are trending in the right direction. And the fourth is size. FDEV scans the international universe, Europe, Japan, emerging markets, and filters for these specific factors. It counters the US growth bias in your VOO holding by adding international value and quality. But here is the reality check. FDEV has an expense ratio of 19%, about 6.3 times higher than VOO. It is also a smaller fund, managing around $228 million. This is a low liquidity warning. You might see wider bid-ask spreads when trading, which is a hidden cost. Most importantly, you need patience. Factor investing can underperform for long periods. For example, the value factor lagged behind growth for nearly 13 years between 2007 and 2020. If you buy this, you aren't trying to beat the market next month. You are building a portfolio that can survive a decade where the US tech growth trade stops working. Now let's talk about a different kind of risk, volatility and interest rates. The last few years taught us that when interest rates rise, standard growth stocks, the ones filling up the S&P 500, can get hammered. This leads us to our third tool, the Fidelity Dividend ETF for rising rates, ticker FDRR. This fund isn't just about chasing yield, it is about sector diversification. FDRR looks for companies that have a positive correlation with increasing 10-year Treasury yields. This naturally steers the portfolio toward sectors like financials, energy, and industrials, sectors that are often underweight in the tech-heavy S&P 500. It also focuses on dividend growth. It wants companies that are raising their payouts, which often signals financial health. Why add this to your portfolio? It's not because it will beat the S&P 500 in a bull market. It probably won't. You add it for the potential downside cushion. In a volatile market where rates are jumping around, the dividends provide a steady trickle of return, and the sector exposure acts as a counterweight to your tech holdings. But again, there's no free lunch. The expense ratio is 15%, 5 times VOO. And while it currently has about $660 million in assets, it is not a guaranteed hedge. If the whole economy tanks, this fund will likely go down too, just hopefully less than the high-flying growth stocks. So how do we put this all together ethically and strategically? I am not suggesting you dump your S&P 500 fund. VOO is fantastic for keeping costs low. I recommend thinking about core and satellite construction. For most investors, keeping 70% to 80% of your portfolio in a broad, low-cost core holding like VOO makes sense. It keeps your overall fees near zero and guarantees you capture the market's long-term growth. Then you can use the remaining 20% to 30% for these tactical satellite positions, FELC, FDEV, or FDRR. By limiting these more expensive funds to a satellite position, you control your costs. A fee of 0.18% on a small portion of your money is manageable. On your whole nest egg, it adds up. Also, a quick note on taxes. While these are all ETFs, which are generally tax efficient, enhanced funds like FELC have higher turnover, meaning they buy and sell stocks more often inside the fund. This can sometimes lead to capital gains distributions, so keep that in mind if you are holding them in a taxable account. And that brings us to the summary of our journey today. We didn't talk about getting rich quick, we talked about staying rich. We learned that VOO, while great, exposes you to significant concentration risk in just 5 or 6 tech companies. We explored FELC as a tool to systematically reduce that concentration risk through active rebalancing, accepting higher fees for potential stability. We looked at FDEV to break out of the US bubble, using international factors to diversify our geography and investment style, acknowledging that it requires years of patience. And we discussed FDRR as a way to inject sector diversity and income into the portfolio to help weather interest rate volatility. These tools won't make you rich overnight, and frankly, in a roaring tech bull market, they might even lag behind the S&P 500. But that is not the point. The point is survival. These tools may help your portfolio survive the next tech correction or a lost decade of US underperformance. That's not about beating the market. It's about staying in the game long enough to let compounding do its work. Thank you so much for spending this time with me. If you found value in this balanced, risk-focused approach, please do me a huge favor. Smash that like button. It really helps the algorithm find other investors who are looking for honest education. Make sure you are subscribed and hit that notification bell. And listen, I want to hear from you. Drop a comment below. Tell me, how are you handling the tech concentration in your portfolio? Are you comfortable with it, or are you looking to diversify? Let's start a conversation. Until next time, keep growing, keep learning, and stop defaulting. I'll see you in the next episode.